Right now it takes about, up to 240 days or so, which is about 8 months for some of these crypto ETFs to be approved. So this could be cut down to just a couple of months, basically. So it's going to be a huge difference here.
All right, joining me will be Amrita Nandakumar, president of Vident Asset Management, who operates one of the most successful sub-advisory businesses in the ETF space. So they are currently the sub-advisors on 100 ETFs globally, some $20 billion in assets. And we'll touch on this, but an ETF sub-advisor, they handle a lot of the behind-the-scenes management of an ETF. So everything from portfolio management and trade execution to compliance. They can help with product development. The bottom line is that they play a critical role in the functioning of an ETF. But what's interesting is because of this perch that Amrita occupies in her role with Vident, she has a front row seat to everything occurring within the industry. So she basically sees and hears everything. And we're going to have a fairly wide-ranging conversation around what she is seeing and hearing right now around ETF product development. I want to ask her about the multi-share class structure, which essentially just got the green light from the SEC last week. I'm also curious to hear her thoughts on how the SEC is approaching regulation of the ETF industry overall, which obviously that impacts product development. So a lot we're going to cover. And this should truly be an interesting conversation with someone who is one of my favorite ETF resources. Now, to start, I am joined by another one of my favorite ETF resources, Roxanna Islam, head of sector and industry research at VettaFi. And we're also just going to go around the world of ETFs right now. So we'll actually cover a few of the same topics as I'll touch on with Amrita. But Roxanna always provides a unique perspective. And so let me now welcome her in. Roxanna, it is always a pleasure. Thank you for joining me.
Yeah, Nate, it's always great to be here as well.
All right, so this is going to be a fun podcast because I'm just going to jump around on a variety of different topics with both you and Amrita, as I mentioned. So I really am looking forward to this. Let's start with what's probably the biggest recent news in the ETF space. And actually, this will probably end up as one of the top 2 or 3 ETF stories for 2025. And that's the SEC indicating that they're finally approving Dimensional's ETF share class structure, which will allow Dimensional to offer an ETF share class of their existing mutual funds. And of course, as I know you're well aware, there are some 75 or so other fund companies pursuing this as well, including some who are seeking to offer a mutual fund share class of their ETFs, which we don't have to get into that. Now, look, Roxanne, I'm sure we'll be covering this story in much more detail over the coming months as more fund companies are approved for this structure and products start coming to market. But I'm just curious, do you have any initial reaction? This has been a long time in the making.
Yeah, we've been waiting for this for a long time. So it's big news because I've had people ask me, how big news is this? It's a pretty big deal. So we're glad it's happening. It's happening basically on track with what we thought. We thought it'd happen by the end of the year. So it's going as planned. I think as an analyst, there's 2 different ways to look at it. First of all, from an investor perspective, there's a lot of good things here actually, which is great. They're going to have more investment choices. The investment choices that they're going to have are more liquid, they're lower cost and tax efficient. So really great for investors that they're going to open up these share classes. For issuers, I think the topic is a little bit more complex. There are a lot of managers, like you said, that have filed for this, between 70 to 80 different managers. So it is something that is very desired and has a lot of advantages. Managers can easily become more competitive as attention in the industry shifts more from mutual funds to ETFs. And they don't have to start from scratch, which I think is a huge a deal. You don't have to file for a whole new product with this. So there's a lot of efficiencies behind having that track record and already having that scale behind the mutual fund. That'll be a big advantage. But, I think there are some intricacies and complexities that they're going to have to deal with and think of, such as how they're going to manage it from the inside internally, and, maybe even some of the loss of revenue from those mutual fund fees. So I think some of the issuers like Dimensional, like FM, they're going to be happy to start this as soon as they can. They've done a lot of work preparing for this, but, maybe some of the other issuers will hold off a little bit until 2026, take sort of a wait and see approach to see how this happens. So I think we're going to see a greater effect coming in 2026 from this. We're going to see sort of a slow start in 2025 as this sort of ramps up.
I think those are all excellent points, and a couple of items that I'll just tack on here. And some of this I'm going to get into with Amrita a little bit later. But I think you're right in terms of operationally, there's a lot that has to go on behind the scenes for fund companies to actually be ready to deliver these ETF share classes. And there are also some complexities. You mentioned intricacies and complexities just with broker-dealer platforms or wirehouse platforms where you have 12b1 fees on mutual funds. You don't have those on ETFs. And so how will that work? What's the incentive to offer ETFs on some of these platforms? Can you have a situation where a mutual fund is basically paying for access, but the ETF isn't? There are some things behind the scenes that I think are interesting, but just high level from a fund company's perspective, I think clearly this is a huge deal because I feel like fund companies can now have their cake and eat it too, in that they can continue to maintain their very lucrative retirement plan business, which of course is dominated by mutual funds, and they can now much more easily pursue the ETF market, which, as we know, that's where all the growth is. And prior to this, the way that these companies would approach the ETF market is maybe they would launch a clone strategy of a mutual fund, which isn't quite as efficient. Or maybe they would try to convert a mutual fund to an ETF. But the problem with that, a conversion really wasn't an option for any mutual fund if it had a lot of retirement plan assets. And so I do think from a fund company perspective, clearly this is a big deal. It's another way to bring strategies to market. To your point on investors, I agree. I think generally more choice is good, but I do worry a little bit about the flood of products coming to market because I think it's already somewhat difficult to differentiate between a lot of the actively managed strategies in an ETF wrapper. And now if you think about it from an investor's perspective, they're going to get hit with a boatload more of these, whether it's over the next few months or next couple of years. I guess, does that concern you at all? Again, I'm all for more choice for investors, but there's going to be a lot of product out there.
Yeah, and I guess we'll see how this shapes out because, as you said, there's already a ton of ETF products. There's more being launched every day as we speak. So there's already a lot out there. So, I guess we'll see how it'll shape up with, how much this will bring to market. But I do agree that there's a lot to parse through, especially for an investor and, even advisors. It can be overwhelming to have too much choice sometimes.
Yeah, and I think on the active side, look, if you're running a highly differentiated strategy, you have high active share, yeah, there's a place for that, clearly. But already I'm looking at a number of active strategies, say on the equity side in particular, where it's really difficult to differentiate between them. They all, not all, but a lot of them sort of look the same. And so I do think that's going to be a challenge. But again, I think overall, clearly more choice is good. And for fund companies, clearly a huge win. Okay, so if we move away from the ETF share class structure, but let's stay on the regulatory front, it looks like we're going to have a bunch of spot crypto ETF set to come to market any day now, assuming this government shutdown doesn't hold up the show for too long. And without getting too far into the weeds, I know you've covered this very closely. Of course, the SEC approved these generic listing standards a few weeks ago, which that makes it much easier for spot crypto ETFs to launch. What are you expecting to see here over the next several weeks or months ahead?
Yeah, speaking of being overwhelmed by funds, this is also another case where we might be a little bit overwhelmed by the amount of new products coming into market. But this is also a big deal. It means that exchanges don't need to file the 19B4 every time, and it makes the review process not as drawn out. So, approvals will come faster, more efficiently. We'll have more of these products into market. Right now it takes about, up to 240 days or so, which is about 8 months for some of these crypto ETFs to be approved. So this could be cut down to just a couple of months, basically. So it's going to be a huge difference here, and I think it's going to be good news for everyone involved in launching these products. It's going to be faster, more efficient, and I think investors will be a little bit more happy if you want these products. I mean, you don't have to wait 8 months to see something come out anymore.
Do you have any thoughts on what demand might look like? And it's interesting. I know that you recently wrote a piece on all of this, and in that piece, you had a VettaFi survey where it was something to the effect of, has a crypto-friendly regulatory environment changed your attitude towards investing in Bitcoin specifically? And if you looked at the poll data, I would say the majority said they were more interested. I think there was a decent chunk that said they were already pretty interested. Now, that was specific to Bitcoin, but as we move down the cap spectrum in the crypto space and you start getting into some of these other assets, any thoughts on what demand might look like?
Yeah, I mean, I think we'll see demand come in slowly. I think a lot of investors, they like Bitcoin. I mean, a lot of investors don't want to go anywhere beyond Bitcoin. It's just, they have their Bitcoin, that's it. They're not very interested in this broader crypto universe. But I think there is a place for, a lot of investors and advisors. Once they start seeing that this is a legitimate asset class, they're going to want to start diversifying within it more. So we're going to have that opportunity with more of these products. They're also going to be able to use more of these products that are more toolkit type products, like the income products and the buffer strategies products. So I think there's going to be, once again, a lot more choice here for investors to explore crypto if they so choose to.
By the way, in talking about demand, I would say specifically for spot Bitcoin or Ether ETFs, this is not a regulatory item, but did you see this report that Vanguard is considering allowing brokerage access to spot Bitcoin and spot Ether ETFs for clients on their platform? I'm just curious, did you have any thoughts around that?
Yeah, I mean, I think this would be great news because that was a huge barrier. I mean, Vanguard's one of the biggest brokerage platforms. So that really opens up access to so many more retail investors. I mean, it helps with the reputation. When you have these big institutions out there saying that they don't like Bitcoin, they don't think it's appropriate, even if you're not on their platform, that sticks in your head still. You start thinking, well, maybe if all these guys say that Bitcoin isn't so great, maybe I shouldn't look into it. But I think it's sort of a rumor right now, but I think it's we're likely to see it happen. I mean, we've seen other institutions do this when they come out first and they say, well, we're not a huge fan of Bitcoin. We're going to put some barriers up to investing. And then later on, they take down those barriers and then they become more supportive of Bitcoin, when they see the direction that it's going. So, I think it's going to be interesting, especially seeing how they implement this. Like, are they just going to allow Bitcoin products? Is it going to be Bitcoin and Ether, or is it going to be everything? Are they going to let you invest in Dogecoin ETFs? So that'll be interesting. If you ask me, I think they might go all in and just allow everything because that puts them on the same playing field as a lot of the other platforms. But I guess anyone's guess is as good as mine which direction they're going there.
Well, it's a little bit of a slippery slope for them if they do allow access to spot Bitcoin and spot Ether ETFs, because then it's like, well, where do you draw the line into exactly what you're saying? If we see, or when we see this wave of spot crypto ETFs hit theoretically later this month, and you have spot XRP and spot Solana and spot Dogecoin, how do you draw the line on that? Because at some point, you're almost making an investment decision on behalf of your clients. I've said the same with BlackRock. Like, I'm surprised BlackRock hasn't actually filed for spot XRP and spot Solana ETFs, because by only offering spot Bitcoin and spot Ether, you're basically saying it's those two and nothing else. And maybe you can set Bitcoin aside and say, okay, that's clearly different, but I don't know that you can do that with Ether. And so you're saying, okay, it's going to be Ether and nothing else out there. It'll just be interesting to see how Vanguard handles that. Which, by the way, in terms of all of these spot crypto ETFs coming to market, obviously investors will have to decide how they want to approach these in the context of a portfolio, if they want any exposure at all. I think, Roxanna, I'm a huge proponent of just taking an index-based approach to investing in general. And with the generic listing standards in place, we are now starting to see index-based crypto ETFs roll out. And again, I'm very bullish on demand for these because, particularly if you're an advisor and you just want exposure to the space, instead of trying to pick the winners, instead of what I was just speaking to, Ethereum or Solana or whatever, just take a basket based approach. Do you have any thoughts around index based crypto ETFs?
Yeah, I mean, I totally agree with you, and I think a lot of analysts and other people in the industry do as well. I mean, these index basket multi-token ETFs, these are a very cool product because you do get that diversified basket exposure to crypto that we were talking about earlier, and I don't think there's as much attention as there should be on these, though, at least from the investor perspective. I mean, we saw GDLC finally convert, I think just a week ago. And it's still seeing some outflows, which I don't think is unusual. It's, a lot of the existing investors, they sell at the conversion, just like with GBTC. But, I have some theories, and it goes back to what we were talking about with demand. First of all, I think a lot of investors, they just want Bitcoin. That's it. That's sort of their crypto exposure. They don't need to go deep into the weeds. But I also think we get a lot of risk chasers in the crypto world, and they're sort of viewing crypto ETFs the same way they would view like a leveraged ETF or a single stock ETF. So they like a lot of these single asset crypto ETFs, like the ones that have came out recently, like the Solana from Rex Osprey and the Dogecoin one, and they have some XRP ones that came out that are futures based. I mean, these have gotten some relatively good attention. So I think, people are sort of looking at some of these as making tactical plays. But I do think as the industry matures, we will start seeing more investors desire that strategic allocation to crypto and looking more closely at these indexed basket products rather than just the single asset products.
Yeah, that's exactly what I think as well. I get it. A lot of investors are only comfortable with Bitcoin right now, but I do expect that to evolve as the space, to your point, matures and people learn more about what's actually happening in the crypto sphere. But taking an index-based approach, I think we would say to any area of the market, whether it be equities or fixed income, the data has proven that's a typically smart way to approach any space. And now you have, like I saw the last week, Hashdex. So they have the NASDAQ Crypto Index ETF, ticker NCIQ. That actually now is the first ETF to hold 6 crypto assets. So you can get exposure to Bitcoin, Ether, XRP, Solana, Cardano, and then Stellar, believe it or not. And I saw a quote from the Hashdex CIO. This was to Blockworks. Where, listen to this. He said, there is a chance that in 5 to 10 years from now, this index could have, he said, 20, 50, 100, or 200 assets. So think about that. But I don't know that I could disagree with that. Again, as the space evolves and the regulatory environment clearly is evolving as well, I think you could see just a boatload of crypto assets come into these. But yeah, it will certainly be interesting to watch. With our remaining time, I know we're jumping around on some different topics here. I want to move from crypto ETFs to precious metal ETFs, and specifically the mining ETF. So I was looking at the performance leaderboard this morning. If you exclude leverage and inverse ETFs, the top ETF performers, they're all gold and silver mining ETFs. Like the top 4 or 5, those are all miners. And if you start going down, like go beyond that, the mining ETFs are dotting the leaderboard, even below that. And I know that you love covering the commodity space, something that you do very closely, just like with crypto. Any insight into what's going on here? Because you look at the returns, we're not talking, marginal returns. We're talking about well over 100% returns this year, 120%, 130%, even 140%. So what's been going on?
Yeah, I mean, it goes back to the underlying commodity. So gold and silver are doing very well right now. They're at highs. And, there's obviously a lot of elements in the economy that are contributing to this, to wanting that sort of safe haven play. And gold is especially a safe haven. But, silver a little bit to an extent has the same sort of thesis behind it. So that's sort of what's driving a lot of that underlying commodity. And then you're also seeing some central bank buying, which has been contributing to some of these inflows into the ETFs. And if you look at some of the performance figures, I pulled some from the end of the quarter earlier yesterday. So GLD, it's up around 47%, has almost 16 billion in net inflows year to date. IAU, very similar, has almost $10 billion. Same story if you look at silver, but maybe not as pronounced. SLV is up about 60% with about almost 2 billion in inflows. So a lot of attention going into the underlying commodity. That also translates into the miners. And as we all know, miners are leveraged plays. So typically when the underlying commodity does well, the miners do even better. But when the commodity does poorly, the miners do even worse. So that's why we've sort of seen these ETFs up in the leaderboard. And, like you said, some of these GDX was up 125% year to date. And it's had, interestingly enough, if you look at outflows, or if you look at flows figures, GDX has about 4 billion in outflows this year. So it's not the same story, which is an interesting dynamic. Like it's not seeing the massive amount of inflows that the gold ETFs are seeing. But, several reasons behind that. Miners do have that added equity risk. So investors traditionally don't go to these as safe haven plays. They traditionally just go to gold ETFs or silver ETFs. And then they usually buy and hold them, for relatively long term. These miners are more tactical plays. A lot of investors look at them when, they see gold prices going up, they buy them and then they sell them to take profits. So they're not the same sort of defensive type positions. But I think it's a very interesting environment for these miners. If you understand the way they work, you can potentially get, a lot of good performance out of them when you're seeing gold and silver come on their up cycles. So very interesting to me.
I'm really glad you mentioned that point on the outflows from the gold miner ETFs, because that just jumped off the page at me. And I know I'm a broken record, but typically in the ETF space, what do we always say? We say that flows follow performance. And so when you see ETFs up again, 120, 130, 140%, and then you go look at flows and there are outflows, that doesn't comport. And I was looking at the gold mining space overall. You mentioned GDX, which is the bulk of the outflows, but I think it's around $4.5 billion in outflows from the gold miners overall. Now, silver miners, they have seen inflows. Last I checked, somewhere around $2 billion year to date. But it is a very interesting dynamic. And it probably does go back to what you were saying, and that these tend to be, I think in general, more tactical vehicles for investors versus something like GLD or SLV, which would probably occupy a longer term buy and hold position in a portfolio. I guess on that note, and you touched on that, but the popular refrain around gold and silver mining ETFs is that they are leverage plays on the underlying. Is that how people should view those? Is it that simple, or is there more to it? I mean, you mentioned the equity risk, but in general, as you noted, typically if gold's up, the miners will be up more, and if gold's down, the miners will be down more, and same on the silver side.
Yeah, I mean, I would say in general, they do follow that pattern. So you would expect miners to be up more when gold is up more. And like I said, there is an added equity risk premium. So, a lot of these products, you have to, they are stocks. So you have a company to deal with, you have management, you have operating costs that may be unique to that particular company that don't make sense for the industry. So there's a lot of added layers to it. But, I think it's a similar story as the crypto miners, who often don't get as much attention as, the spot Bitcoin products because of this added layer of complexity.
Well, Roxanna, a nice little tour around the world of ETFs. We hit on the gold and silver miners, crypto, of course, and the multi-share class structure. So fun chat this week. I always enjoy visiting. Thank you for joining me.
Yeah, thank you for having me, Nate. Great chat.
That was Roxanna Islam, Head of Sector and Industry Research at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
I'm now joined by Amrita Nandakumar, president of Vident Asset Management, who, as I mentioned at the top, Vident operates one of the most successful ETF sub-advisory businesses out there, which currently totals about 100 ETFs globally, some $20 billion in assets. And we'll talk more about that sub-advisory business here in a moment. But Amrita herself, she's one of my favorite people to visit with because she truly has her finger on the pulse of everything occurring in ETF. She has a front row seat to product development and regulatory matters, really anything touching the ETF space. And I should note that prior to joining Vident, Amrita was Director of Corporate Strategy and Development at VanEck, who, of course, is a top 10 ETF issuer. Before that, she was with Vanguard as a senior investment consultant. So this is someone who has pretty much seen everything in the ETF space, and she's now joining me from New York. Amrita, it is so great having you back on the podcast. It's been way too long.
Yes, good morning. Thank you for having me. It's great to be back. I was just reminiscing yesterday that I think the last time I was on was when I first joined VanEck, I should say Vident, and that was 5 years ago. So time has really flown because it doesn't feel like it's been that long.
It has, and a lot has changed in the ETF space, some of which we'll get to here in a moment. We are going to go around the world of ETFs here because, like I said, I have a number of topics I want to get to, but I do want to start with Vident because I find that this sub-advisory role that Vident occupies, this seems to sometimes confuse people for whatever reason. And so if you don't mind, can you just explain what Vident does at a basic level? Like, what is an ETF sub-advisor?
Certainly. So for those folks who aren't aware, Vident Asset Management, we're located just north of Atlanta, Georgia. And as Nate mentioned, 20 billion in assets under management across ETFs, CITs, SMAs, UCITS. We're quite vehicle agnostic in that respect, but ETFs very much our specialty. So with sub-advisory or ETF sub-advisory, I should say, I can understand why that would be confusing because in some ways it's the opposite of the traditional sub-advisory model. So let's say you're a large growth manager and you want to devote a sleeve of your mutual fund to something completely different. So you'll scour the universe for your favorite manager in that asset class and they will quote unquote sub-advise that sleeve of your mutual fund. So in that respect, that sub-advisor is providing the actual investment strategy. We kind of do the opposite. So we work with issuers who already have a strategy in mind. Maybe they have an index that they want to track, or they have an active strategy that they've been managing for some time and want to implement in an ETF. And so even the most experienced managers, mutual fund, SMA, they start feeling like a fish out of water when they begin to understand the trading and operational and capital markets requirements of launching an ETF. And that's where Vident comes in. We really end up becoming an extension of their investment management and operations teams. So we specialize in portfolio implementation, trading, and capital markets for our issuers. So if you're familiar with model delivery, like TAMPs, like InvestNet, it's in many ways a very similar model where our clients send us their target portfolios, or if it's an index, we get sent the index file and we actually put put the assets to work. So we're doing the trading, we're working with liquidity providers, we're watching spreads, we're working with all of the the service providers that are really needed to bring an ETF to life. And what makes Vident especially interesting, I think, is that we are an open architecture platform. So our clients pick the trust they want to work with, the admin, the custodian, the exchange they want to list at, the distributor they want to work at. We pretty much work with everybody in the ETF industry. So even though we're not a household name, we're definitely well known in the ETF industry. It's very, very easy to ask about us. And so just given the breadth that we occupy in terms of the number of issuers we work with, we're currently working with 32 different issuers, we often get a first look at product innovation. We get a first look at the trends that we're seeing, the types of newer types of issuers that are coming to market. And so, as you alluded to, I think in some ways I get to occupy a very special seat because in some ways I get a preview of what's coming next, and that is very exciting.
That is well said. You're giving me a perfect segue here because I do want to get into some industry topics. And you do occupy just such an excellent perch in the ETF space because of everything that you described there. And so let's dive into some industry topics and let's just stay on the product development side to start. I think that's probably the easiest place for you given what you do. And I guess first, Amrita, we continue to see a lot of new entrants into the ETF space. I'm curious if you can categorize them at all. Like, is there any commonality among the types of asset managers that are currently coming to market? And it's funny because ETFs, of course, have been around now for greater than 30 years, but yet still we continue to see new players come in. And I'm just curious if there's any commonality there, and maybe you can add some color as to why these asset managers are now coming to market. Like, what's their rationale for launching an ETF strategy?
Sure. So with Vident, I find that the kinds of issuers that tend to, resonate are folks that are really beginning to understand that ETFs are a tool. They're not strategies to be competed with, but rather they're a tool like any other, like a mutual fund or robo-advisor or any direct indexing, any of the innovations out there. And what the ETF can do is provide an entirely new distribution channel for more experienced investors, such as hedge funds, traditional asset managers, family offices, RIAs. And so for those folks, they see, okay, an ETF could allow me to expand my brand awareness, could allow me to access retail, could allow me to access financial advisors that haven't been able to get access to my strategies before. And of course, we all know the democratizing value of the ETF in terms of being available on most platforms, low cost, no investment minimums, virtually available to the most sophisticated investors down to, my mom. And so that's become an easier conversation. So when folks are reaching out to us, expressing an interest in launching an ETF, they already understand what the potential is if they can be successful in this space. And so, we're seeing asset managers looking to implement either convert or clone strategies that they've been running for 10, 15, 20 years, hedge funds that are really testing the limits of the ETF wrapper and trying to bring their hedge fund strategies to a broader audience. And then, of course, everyone's favorite topic du jour, the 351 exchange. A lot of conversations there with family offices and RAs who understand that the ETF can offer them tools that they currently don't have in their current mutual fund or SMA wrapper.
It's just so interesting, the types of asset managers coming into the ETF market. It really does run the full spectrum, as you just described there. I mean, we just recently had Raymond James, huge asset manager, finally get involved in the ETF space. You have hedge funds, you have advisors who are converting SMAs or looking at 351 exchanges. There are just so many unique ways asset managers are becoming involved in the ETF space. Again, some 30 years after the launch of the first ETF. In terms of specific ETF ideas, when you think about ETF innovation right now, I'm curious, what are you seeing? So we just talked about, the types of players getting involved, but what are some of the biggest areas of interest from these asset managers?
Yeah, certainly. So, one common theme that we're seeing is that the types of aspiring issuers that are approaching us, they really seem to have their pulse on what the market is looking for. And by the market, I mean their target investor segment. In many cases, these are financial advisors and RIAs. They have taken the time to understand what these audiences are looking for, how they are researching and implementing ETFs in their portfolios. And they also understand what the pain points are for these different investor segments. And so they're developing tools that allow these folks to invest with a little bit more ease, whether they're solutions, they are, generating income through a mix of traditional high yield along with options. They're managing volatility, or they're just providing more sophisticated alternatives exposure than has traditionally been available in the ETF wrapper. And so for us, that's been really interesting because, I alluded to this earlier, these folks are really testing the limits of what the ETF wrapper can do. And that's one of the first conversations we have with folks who are, in the mutual fund space or their hedge fund advisors. And we say, remember that this is a publicly listed fund that trades all day. And so there are certain operational limitations. There are certain regulatory limitations that you may not be used to as a sponsor of an SMA or a private vehicle. And so those folks aren't necessarily daunted when they hear that. Rather, they turn to us and say, okay, will you tell us how far we can go? And that's fun for us because it really motivates us to continue to innovate and stay ahead of our clients so that when they're ready for us, we're ready for them. So in that respect, it's been really fun to see how far innovation has come in the ETF wrapper.
In terms of testing the limits of the ETF wrapper and innovation, you mentioned 351 exchanges, which I don't know if you know this, but at the beginning of the year, I predicted that 351 exchanges would go mainstream. I think we're starting to see that. Can you talk more about the interest that you're seeing here? And it might be good, we don't need to go into the weeds, but if you can provide just a little bit of background on what a 351 exchange is as it pertains to the ETF wrapper.
Sure. The thing I always find interesting is that, people often wonder, where does the term 351 come from? So Section 351 is actually a provision of the Internal Revenue Code, which states that in some cases, if investors provide shares provide assets into a newly formed corporation, they can get shares back, and this would not trigger a taxable event. And so even though this is something that the ETF industry has really adopted and claimed as our own, this is actually something that has been around for a long time. And so just a very strong example of innovation in the ETF industry, taking something that's been buried in the Internal Revenue Code and is now a tool that people are getting increasingly excited about. So certainly an increasingly popular option for family offices and RIAs that have been managing legacy assets. And they have, these potential capital gains that they want to manage more efficiently. But they also see that on an ongoing basis, the ETF wrapper allows them tools towards tax management that they don't necessarily have in their mutual fund or they don't necessarily have in their SMA. And so what's interesting to me is that a lot of the folks that are interested in utilizing the 351 wrapper aren't necessarily looking to raise assets. They're not really worrying about distribution strategy. Rather, they have a bulk of assets, BYOA, as our friend Eric Balchunas likes to say. So they're bringing their own assets, but at the same time, not really worrying about distribution. And so, given what those of us who've been in the industry for a while know, having assets and having a sound distribution strategy, or in this case, not really needing a distribution strategy, in some ways really makes you the ideal ETF issuer.
I love the use of the ETF wrapper for this, and I thought you described it well. The way that I like to think about this, imagine an investor who they have a portfolio of individual stocks, and we know the market's done really well here over the past several years. So imagine those stocks have really run. Maybe they own some NVIDIA and Microsoft, et cetera, Bag 7 stocks. And so they have large capital gains. They're holding these in a taxable account. Well, essentially, and there's some very specific rules around this, but in general, you can take that portfolio of stocks exchange it for shares of an ETF. So these ETFs are set up. They're typically diversified strategies. And so what happens there is you don't pay tax when you receive those ETF shares. You're just moving your individual stocks into this ETF. In return, you get a diversified basket versus your maybe more concentrated portfolio of NVIDIA, et cetera. And then you can sell when you want. At the point that you sell those ETF shares, obviously you'll have a capital gain at that point. But it's really a way you can defer those taxes. You can get diversification if you have a concentrated portfolio. You still get all the benefits that we tend to see in an ETF wrapper in terms of lower cost, clearly the tax efficiency of the ETF itself. And so I love seeing the ETF wrapper used for this. And it sounds like with what Vident's seeing, you're seeing a lot of interest here. And so it sounds like you think my prediction of 351s going mainstream is going to, I'm going to get a green check on that one.
Yeah, I think you should go ahead and give it to yourself already. I don't think you need to wait until the end of the year. I think your explanation was spot on. And one of the things that I've found interesting is that lately we've been talking to aspiring issuers who are looking at 351 as a way to also convert their strategy. And so, as you said, starting with a concentrated portfolio, maybe they just want to go to a broader index exposure, or maybe they want to move from a basket that also has international names to something more domestic. And so that's the beauty of the conversion, is that it gives managers flexibility in terms of what they want the portfolio to look like in the long term. And so that's before it was very much, we have this strategy A today, and we're going to maintain strategy A in our ETF. It's just we're simply changing wrappers and taking advantage of the tax deferral benefits. But in this case, it's more recently people looking to make some, I wouldn't say drastic changes, but certainly more than they would have been able to if they had just stuck with the current wrapper and had to worry about the taxes that they might have incurred if they just managed it, as they normally would have.
Speaking of the potential tax benefits of the ETF wrapper, I want to switch gears here and talk about some pretty big news that we had last week with the SEC indicating that they're going to approve the multi-share class structure. And so I know you have followed this very closely. This approval was specifically for Dimensional, but it looks like they're going to approve this for any asset manager who conforms to Dimensional's filing. And I'm just curious, as again, somebody in your perch, what do you think this means for product proliferation or innovation? Like, how big of a deal is this?
I think this is huge in terms of the interest that this is going to generate. It's going to bring out a lot of aspiring issuers who've been waiting on the sidelines. I think we're going to see just a proliferation of new filings and even more players to the ETF marketplace, which is so exciting. And we already know that there are far more ETFs listed in the US than there are actual companies, and that number is just going to continue to explode. So in that respect, I think this is a very, very positive outcome. What I spend time thinking about is the fact that I think some folks are really underestimating how easy this is going to be. I think that there's a lot of things that aren't being reported as well on, because who wants to report on or talk about operational limitations? Who wants to talk about Reg BI? But the truth is that these are important questions that need to be addressed. And so the industry, I think, has done a good job of focusing on these issues. For example, for traditional broker-dealer platforms, do they have the operational rails or the technology in place to support an additional share class, an ETF share class of a mutual fund that might already be on their platform, and the ability to be able to move in and out of these wrappers? And who's going to pay for all of that work? Who's going to pay for those investments? And going back to the broker-dealers, regulation best interest. Once those ETF share classes are available, do these broker dealers have an obligation to move their existing mutual fund investors into the ETF? What is their potential liability from a regulatory perspective? And then, of course, I think the most glaring one is the ETF's lack of 12B1 fees and other trailer fees. And so to the extent that folks are moving from the mutual fund to the ETF, or they just opt to go to the ETF directly, what that means for lost revenue for the broker dealers, and how, what potential obligation does the asset management industry have to make them whole? Or how do they in general think about what that revenue loss is going to be for them, and how do they make up for it? And so I just think that, yes, these are not the sexiest issues to talk about, but they are significant issues. And so, yes, we'll see a lot of excitement. We'll see a lot of new filings, and Dimensional, I'm no doubt that they will be able to get out the door. But I think it's going to be a while before we see the fruits of this big step in terms of what that actually means for new ETFs.
I think those are some excellent points in terms of the back end plumbing. And it's interesting when you think about the broker dealers and wirehouses. I saw a study last week. This was reported by Bloomberg that I think you would appreciate, with a point you were just making, where they referenced Cerulli Associates, and they estimated that fund distributors, so wirehouses and broker dealers, they could risk losing between 15 and $30 billion a year in fees that they're currently collecting from mutual funds, if those funds were to convert into the ETF share class. So you're talking about real money at play here. And, for better or worse, money drives incentives in the space. And so I think you're right in that there's some of these issues that it's not that they haven't been thought through, it's just that they're more complex than I think what people are giving them credit for. So I think that'll be really interesting to watch. Let me ask you this. In my prior segment, I was talking about how, look, and I think you would agree with this, especially given what Vident does. I'm all for more choices for investors. But as we have all of these ETF share classes begin to roll out, and I think, as you know, a lot of these are going to be actively managed strategies, I feel like it's really going to raise the bar for due diligence for investors, because there's a lot of these strategies that look very similar. And so investors are going to have to spend that much more time and effort, advisors as well, combing through these strategies to really understand the differences. And so, again, I'm all about investor choice, but does that concern you at all, that it's almost like there's too many products coming to market?
Yeah, that is something I've thought about, is how is the investor community going to handle it, but also how are we as service providers going to handle it? If the approval of this structure really does lead to the flood of filings and the flood of new funds that we all hope it does, are we as an industry ready for it, frankly, just from an operational and volume perspective? So I think what'll happen is kind of what's happened all along with the ETF industry. Is you've seen over time more and more new issuers, more and more new product, but either one of two things happens. Either issuers themselves self-select out and say, you know what, the opportunity cost of keeping this fund open is too high. I'd rather divert those resources elsewhere. Or investors will sort of make their voices known when they don't show interest in a fund and the fund doesn't generate assets, it doesn't generate volumes. And so I think what'll happen is you'll see a bunch of new listings, and then 2-3 years afterward, which is typically when most issuers start thinking about, okay, do we want to continue to invest in this fund or not? We'll start to see a flood of closures. So I think over time, it'll work itself out. But to your point, yes, I think there will be a point where everyone just feels flooded with product. And you're right, at some point, is it too much for investors? Will they be able to manage all of the due diligence, or will this become a paradox of choice situation? I guess that'll remain to be seen.
Well, and I do like your point too, just regarding the cost benefit from the issuer's perspective, because if you actually read through Dimensional's filing, there's a significant burden on fund companies to ensure that one share class isn't subsidizing the other share class in terms of cost and taxes and those sorts of things. And so you have fund boards that have pretty substantial responsibilities to monitor that on an ongoing basis. This isn't something where you just roll out an ETF share class and boom, it's out in the market. So will be interesting to see play out. Again, I think certainly a huge win for the industry overall, but much more complex than maybe what people have thought about. Amrita, just a few minutes left here.
Really good point.
Yeah, go ahead.
I think that's a really good point that you made about the fund boards. And again, one of those potentially esoteric topics that we probably don't talk about enough, but certainly something worth mentioning. So Vident currently works with 23 different 40 Act trusts and trust boards on behalf of our clients. And so something that we've started educating them on is that for their colleagues who may be sitting on boards of mutual fund trusts, they may be in a situation where they will soon be overseeing ETFs. And so what some folks may not know is that typically a 40 Act investment trust can support both mutual funds and ETFs today. So in a situation where you have multi-share class, it would be logical that the ETF share class would also fall within the same trust as the existing mutual fund share classes. And so what our clients find most interesting is that when they think about what this means, they assume that it's going to be a huge regulatory and compliance burden. It actually turns out that it's not as much as you would think, because both mutual funds and ETFs fall under the 40 Act. And so what we end up finding is that a lot of our sponsors, they do end up having to come up with more compliance procedures and policies, particularly around 6011 and other ETF specific policies, but it's really not the biggest lift. The biggest lift is operational and trading and education. So trading and operations, in many cases, they turn to a firm like Vident. Maybe they're already working with us. We can help navigate them through that. But what we've been telling folks is understand that what you need to be overseeing as a board, what you need to be responsible for, the questions that you need to be asking, you may not even know what you should be asking, because it's just a completely different structure. And so I think that the sooner that these boards can get ahead of that and be prepared, the better it'll be when they start seeing these ETF shares pop up in their trusts.
We'll see again. That's exactly why you bring a Vident Asset Management into the room to help you navigate these sort of items. I was just going to say, a few minutes left. I noted that you obviously stay on top of the regulatory environment, and that can clearly impact the types of ETFs that come to market and really how quickly they can come to market as well, like we're seeing on the crypto ETF side. And, the general thought, which I agree with, is that we now have a quote unquote lighter touch SEC. And so I'm just curious, as we wrap up our conversation here, what do you think that means for ETF innovation moving forward?
I think that's a great point. For a lot of us who heard that Paul Atkins was nominated as SEC commissioner, I think that's where a lot of our minds went, especially those of us who were familiar with his track record as a former commissioner, or I say a former member of the SEC. So yes, he's gone on record to say that he supports innovation and he doesn't want regulation to be the reason that innovation gets held back. And so with regard to multi-share class, it turns out regulatory wasn't the biggest hurdle, right? It's going to be operational and commercial and all of these things we talked about a few minutes ago. And so I think that's, understandably going to open the door for a lot of product innovation that will be, maybe welcomed a little bit more warmly by our regulator. And I do think that that's a great thing. I just think, like a lot of things, we want to be sure that the pendulum doesn't swing too far either. We don't want a situation, I think, where we have a lot of new innovation, but it's not really innovation that the industry was asking for. We don't want a bunch of solutions looking for a problem to solve. And so, one example that often comes to mind for me is, semi and non-transparent wrappers. The market really spoke in terms of what the need was for those. Right. We all know about, some of the issues in terms of some of the more non-transparent wrappers, issues looking for lead market makers, things like that. But ultimately, it became an operational and commercial decision, again, largely from the broker dealers who didn't have the infrastructure to support them and certainly didn't have the commercial interest in supporting them. And so in that respect, the industry spoke and said, yeah, this is nice, but ultimately we don't really need it. Now, multi-share class is something that people have been asking for. Even before Dimensional's application was improved, there were already 80 people, or 80 firms, I should say, in line, with probably many, many more just waiting to apply. So clearly there's an interest there. How many of those folks will actually launch ETF share classes remains to be seen. I'm sure for a lot of folks, it'll be a nice to have for when they're ready. I hope that the type of innovation we see with a lighter touch in SEC is that type of innovation that people are actually looking for, or they want to have on hand, and not so much, yeah, these are great, but is this something that anyone's actually going to use?
Yeah, I think that's well said. The way I've often thought about this, and this isn't anything enlightening, is there's always a balance between regulation and innovation. And you kind of have a pendulum that swings back and forth there. In my opinion, I think the regulatory backdrop was way too strict. If I look back, say, over the past 4 or 5 years, and it's now swinging back the other way. But I think you're right, too. We have to make sure investors are protected and the types of products and solutions coming to market are also in the best interest of investors. And that's where you get that balance between innovation and regulation. So again, it's something that there's no, I don't know if there's a right answer. There's always going to be sort of a fight for middle ground there, but it'll be interesting to see exactly how this plays out moving forward, because we do have a lighter touch SEC. But Amrita, it is always a pleasure connecting. I greatly enjoyed the conversation. Thank you so much for joining me.
Thank you for having me. I love chatting with you. Looking forward to doing it again soon.
Thank you. That was Amrita Nandakumar, president of Vident Asset Management. That'll do it for this week's ETF Prime. I want to thank one of our sponsors, Webb's Investments. If you would like to learn more about Webb's, you can visit webbsinv.com. Next week, I'll be joined by Akish Doshi, who's global head of gold strategy at State Street. So we will be going in depth on gold and gold ETFs, which, as I talked about earlier, those continue to have just an excellent year. So it should be a nice conversation. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.